Hello and welcome to Macros with Mythili, the ET Now show where we take a hard look at all the major macroeconomic issues and developments in India and overseas. In this episode, we're going to direct that hard look at, well, what else but the Fed rate hike or the increase in the interest rates announced by the US Federal Reserve last Wednesday. Well, the Fed action now is behind us, and contrary to widespread fears, the heavens really haven't fallen, at least not as yet. So can we now breathe easy? Can we presume all well with the world and with the global economy, and that we are on course to a repeat of the nice years, the years of non-inflationary continuous expansion that ended with the global financial crisis of 2008? We've got two very eminent voices to give us their interpretation of the Fed action and what it could mean, particularly for countries like India. We have with us Rakesh Mohan, former Chief Economic Advisor, Government of India, former Deputy Governor, Reserve Bank of India, and formerly Executive Director to the International Monetary Fund, representing India, Sri Lanka, Bangladesh and Bhutan. We also have Anantha Nageswaran, who's been a banker and a commentator on the banking and financial sector and is presently a Singapore-based independent consultant. Welcome to the show, Rakesh as well as Anand. Rakesh, there's been this tremendous sense of anti-climax. Everybody expected, as I said, all hell to break loose. But suddenly we saw not only the US markets, but also Asian markets and all over the world, there seems to be a sense of it's business as usual. So what explains it? Were our fears overdone, overblown? What explains the relative silence right now?
The Federal Reserve learned its lesson from the 2013 taper tantrum. And so they've also, I think, given heed to a lot of the complaints that they received, particularly from emerging markets and certainly from Governor Raghuram Rajan on not giving surprises. So this particular action was perhaps the most well communicated, the clearly expected action, etc. So had this action not been taken yesterday, I would have imagined that the markets would have reacted negatively to action not being taken, given the kind of build-up to the action between the Fed chairs, Janet Yellen's speeches in the last couple of months. So in some sense, it was very, very carefully communicated. I think also worth just recapping for a second the justification and the reasoning that she gave. Let me just suggest to all viewers actually that it's a real pleasure to listen to the Fed chair's press conference because of the clarity of her thought, the clarity of her answers. It's really a model for someone like myself, a former central banker. She hasn't paid me for this ad, but nonetheless, I'm just so impressed by that speech as well as responses that I thought I'd put that out. But let me just very quickly recap that what did she say? She said, one, that the US GDP moderate expansion, the US economic activity moderate expansion is continuing, and they expect it to continue, though at a moderate pace. Second, job growth has been consistent at something around 200,000 jobs per month, and they expect that to continue. In that particular, going in that same vein, that she did mention that the unemployment rate may not necessarily come down much more, because what they're just beginning to observe is some signs of increase in the labor force participation rate, which indeed has been at a very low level for the past some years. And so it is possible now that we might be able to get increasing labor force participation, so that increasing number of jobs may not necessarily mean reducing unemployment.
Well, Rakesh, we'll accept your statement that this is not a plug for the Federal Reserve. But having said that, now let me just ask Anand. Anand, is this the lull before the storm? In your own words, in fact, I think you had said that financial participants felt the world is going to end on December 16th. Instead of which, what do we find? That the world is not only not ended, it's doing quite well, thank you. So my question really is this just a lull? Are we just awaiting the storm to burst? And when will that happen? After the winter vacations, as it were, when FIIs return early January? Are you expecting the storm to suddenly burst?
Yeah, I mean, to give a very short answer, the answer is yes. I mean, I agree with Deputy Governor Rakesh Mohan, former Deputy Governor Rakesh Mohan, that had the Fed not raised the interest rate yesterday, on Wednesday rather, then the financial markets would have reacted with some disappointment, because it's been so widely telegraphed that had they once again barked at rising rates as they did in September, there would have been a renewed burst of volatility. But the markets' sanguine reaction, especially in the stock markets, is probably because the Federal Reserve used some key phrases to signal that future rate actions would be very gradual, very slow, etc. For example, the use of the word only gradually rather than simply saying gradually makes a big difference to stock market investors. But we shouldn't read too much into one day's action. Short-term market action is a lot of noise, and there is no way one can rationalize short-term reactions. And in fact, if you look at the currency markets, this morning in Asian trading, the euro-dollar exchange rate has come down. The dollar has strengthened. So I'm not so sure how long will the stock market be able to keep up with its cheerful reaction to the Federal Reserve decision. So yeah, if you want to characterize it as a lull before the storm, I would go along with that.
Well, I'm not so sure that there will be a storm, but so far, yes, so far so good. But Rakesh, as far as India is concerned, the comparison is very often with what happened in 2013. So we say that our fundamentals are better, so we're not going to see a repeat of 2013. But even if it goes back to 2013, if you remember, Bernanke made a statement about the possible end of unconventional monetary policy on the 22nd of May 2013. But the rupee tanked only much later, actually in July and August. Of course, it slowly started depreciating, but the real collapse came much later. Likewise, can we say that one can never really say for sure that just because our fundamentals are in place now, we won't have a repeat of 2013, because even though there was, even in May 2013, there was no abrupt deterioration in our fundamentals between May and July, and yet markets suddenly reacted much later. And even though Bernanke spoke earlier, so is there something about financial markets that really defies all logic? And that combined with our very thin markets, especially exchange markets, any movement can get exaggerated.
Let me first comment on Anant's comments. The key issue in terms of what may happen going along with the next few months really depends on whether the US economy actually keeps expanding. That is, the issue essentially is that the rate increase is presumably being done with the expectation that the US economy will keep expanding, and that will outweigh the effect of the higher interest rate on everything else. And if that doesn't, so in fact, the kind of negative reaction will happen if indeed the US economy does not keep expanding. So I think that is what we really need to keep in mind, and whether the expectations of the US Fed in terms of continuing moderate expansion are correct or not. Just having said that, now coming to your question, that our macro fundamentals are clearly different today than what we were in 2013. In 2013, we had really widened our current account deficit to almost 5% of GDP. That has now come down to what, 1% or less of GDP now. And so that is a huge difference in terms of, I presume, the market's perception of the level of fragility of the Indian external economy. Of course, a lot of that is because of the oil prices having come down, therefore oil import bill having come down, also other commodities and so on. So I would not expect this rate change to have made as much, to make as much difference, to have the kind of impact that it had 2013. But the question again depends on two other issues going forward in the next 12 months. One, that if that the expectation that given by the Federal Reserve is that there would be about 100 basis points increase over 2016, assuming things continue in the way they're expecting today. So the two questions: one, will it be more than that? If it is more than that, yes, certainly there will be negative reactions. Second, if they continue doing that despite a non-increase in US economic activity, then again there will be negative reaction. And third, as far as India is concerned, that we have been successively opening our external commercial borrowing. I think that if we continue doing that, yes, we will have a negative reaction, because if there's any impact, even a small impact on the expectation of exchange rate depreciation, then there will be very quick redemptions from foreign investments in the Indian rupee bond market, which we've been trying to open more and more in recent times.
So absolutely. So though prima facie we seem as if we're in better health, there are lots of underlying areas of worry. But I'm afraid on that note we slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the fallout of the recent Fed action. Two of the most eminent brains possible, Rakesh Mohan and Anantha Nageswaran. Anand, before the break, Rakesh spoke about how our fundamentals are much better, and that is undoubtedly true. But he also touched upon a point which, in fact, I think you've also mentioned, and the IMF has also drawn attention to, the fact that our Indian corporates are much more highly leveraged today than they were in 2013. And you've been a very severe critic of the Fed's unconventional monetary policy, and you've argued that even if the Fed hikes rates, it'll be too little too late because there's been so much excessive liquidity which has resulted in misallocation of risk. And as that unravels, you could find things unraveling very quickly. So could the Fed have done things a little differently? And are we really in comfort zone given the over leverage of our corporates?
No, I think you raised very valid questions. India will do relatively better. Even with the corporate leverage story that you have mentioned, the fact is it's not a new information. It's been in the price for quite some time in financial markets. So to that extent, financial markets react to surprises, and Indian corporate excess leverage and the very gradual deleveraging story that's happening is not exactly new information that the market has to price in. To that extent, the market risk is somewhat mitigated. That said, we have to remember quite a few things. One is the United States economy itself isn't particularly robust. Although the Federal Reserve might have talked about continued moderate expansion, the truth is it will be the 7th year of expansion in 2016, and this particular subdued or moderate expansion will in any case be long in the tooth. And therefore, the prospect of a recession will keep rising as this economic recovery cycle continues apace in 2016. And secondly, the US stock market isn't particularly cheap, and let me be very blunt, pockets of it are extremely exuberant. The median NYSE stock price earnings ratio is higher than it was in 2000 and in 2007. Yes, the two of the worst bubbles had the median PE ratio of a NYSE listed stock in lower multiples than it is today. So regardless of the expansion being weak or subdued or continued moderate pace, the US stock market could actually start to go down for reasons of over exuberance. If that happens, emerging markets will not be immune. And the third factor that could still weigh against India is the sentiment towards emerging markets, particularly Brazil and China, and therefore if that happens too, then India will be affected. But all that having been said, I would still expect that unlike 2013, India will be a far superior relative performer compared to other emerging markets.
Oh yeah, of course. I think we are definitely better off than we were in 2013, but is that good enough? That remains a big question. But Rakesh, as Anand said, the fear of recession has not entirely disappeared. Now you've just returned from Washington. What is your sense? Would you say that the positive from the US economic recovery more than offsets any decline from a higher interest rate? And in fact, it might even work to our advantage, because then we might see our exports growing, and the strength on the balance of payments front will come from the real sector rather than capital flows at the moment. What is your sense? So will it be net positive for us, or could it be net negative?
No, that's really the key question, of course. But I certainly agree with Anantha that, in fact, there is a strong view among a number of analysts, just as he said, that this recovery has been going on, although very moderate and slow, for almost 7 years, and it's much longer than usual recovery. So there is a view that this recovery can't continue forever, and therefore you're actually on the brink of the US economy actually turning down. And as part of that, the kind of evidence that people look at is that capex investment is really not doing particularly well. And in fact, this was mentioned by the Fed chair as well in a statement. So that's one worry that is certainly there, because given the very low interest rates globally, there has probably been excessive capex investment globally. I'm not just saying United States, and therefore a lot of excess capacity across the world, and particularly in China. And that will keep damping down the inflation expectations and also actual inflation, and also it'll put pressure on the dollar, because there's asynchronous monetary policy now between the US Fed, the ECB, the US Fed on the one hand, and ECB and Japan on the other. So the likelihood of the US dollar being strengthened on a continuous basis as the US Fed tries to increase interest rates is quite high. And that would then dampen both US economic activity and also downwards pressures on inflation. And therefore, if the inflation does not start rising, that would then give either pause to the US Fed to continue what they've said they're going to do. And second, that if they continue in any case, then you'll be increasing real interest rates, which will certainly have an effect on economic activity globally. So as far as India is concerned, to my mind, these things are less important than continuous, what you might call positive, progressive, expansionary fiscal and monetary policies in this country. And when I say expansionary fiscal, of course, in a prudent fashion, but directed towards public investment, I think that India's fate will depend much more on what we do domestically. But of course, at the margin, obviously we're affected by global headwinds and tailwinds. And here I think that we are relatively well placed, certainly compared to other EMEs, Russia and Brazil in particular. China is still a bit of a puzzle, whether they're slowing down significantly or they'll just slow down to 6-7% on a regular basis. That remains to be seen. But overall, it does seem to me that what happens in India would be much more dependent on what we do domestically. And second, as I said, as far as the external side is concerned, that we really need to be careful in continuing to open the rupee bond market to FII flows, because they are indeed the most volatile kind of flows. Just remind yourselves that in 2013, out of the, if I remember correctly, 10 or 12 billion that went out, 80% plus was on debt flows. Not much equity flow went out in 2013. And we're really opening ourselves up, particularly at this stage of the cycle when interest rates are going up.
Anant, Rakesh is entirely right. How we fare depends a lot on what we do internally. But the fact is that the US Fed has de facto become the global central bank. Given that, how can we make the Fed more responsive to emerging market concerns? Rakesh was very kind. He said the Fed has listened to Raghuram Rajan. I'm not so sure it has, because the word hegemon has always been used in a pejorative sense and usually been reserved for the Soviet bloc during the Cold War years. But if you look at the US, it's increasingly becoming the new economic hegemon. We see it in trade deals as with TPP and now with the Fed action. Where I differ from Rakesh, I think the Fed has clearly looked at its own turf and they're not really bothered about what happens in the external, the larger world economy. I know in September they deferred their decision and the general understanding was that it was because of the slowdown in China. But I'm not so sure that the external world really counts for the US Fed. Do you think the US Fed really bothers about the external world, given that the US economy is not really a very open economy?
No, I mean, the US economy has become more open for sure. Now exports, for example, are 12.5% of the US GDP, and that's apparently one of the highest levels in the last 4 to 5 decades. And second, in the press statement that accompanied the Federal Reserve decision on Wednesday, they did say that future trajectory and the magnitude of rate increases would depend on many things, and one of the things they included in that was international developments, international and financial development. So they clearly are giving themselves an excuse to go slow on the rate increases should the international reactions in economies or in financial markets be negative or volatile, and if there are feedback effects into the US. So I think they are probably becoming more sensitive, and they have included that in the press release on Wednesday. So to that extent, they are becoming more concerned. But that said, I don't think there are any formal mechanisms that do exist for the Federal Reserve, or for that matter other bigger international central banks like the ECB, to really take into account what the rest of the world is doing in response to their actions or non-actions. Ultimately, for example, in Switzerland, the Swiss National Bank had to voluntarily abandon its peg to the euro in early 2015, simply because the domestic costs began to exceed the benefits. But the ECB did not change any of its policy actions because it was hurting the Swiss economy, which is very much geographically part of the Central and Western Europe. So I think the bigger central banks we shouldn't really expect them to be very sensitive beyond verbal homilies.
Absolutely. But Rakesh, we can't expect the largest central banks to bother about the rest of us poorer cousins. When can we really relax our guard as far as the Fed action is concerned? Because right now FIIs are celebrating their Christmas, so when they come back in January, say by 15th of January, can we stop worrying about the consequences? What would you say?
Well, let me first say that, let there be no question that the US Fed's responsibility is to the United States and not to the rest of the world. Similarly, I would imagine the Governor Rajan's responsibility is to India and not the rest of the world. So that there should be no doubt whatsoever that the US Fed's first responsibility is the United States. Having said that, the only point to be made now is that they are probably more sensitive in 2015, at the end of 2015, than they were in 2013. And the Fed chair was in fact asked a specific question in a press conference. And she answered saying, yes, we communicate much more now to our counterparts in terms of what we are thinking. They obviously are not going to tell any counterpart what she's going to do. But that's what she said, that we are much more communicative now in terms of being more careful about our communication, about our thinking to my counterparts in the rest of the world. And she said particularly in emerging markets. Whether she does that or not, of course, I have no idea. Second, your second point, which is that when can we let down our guard? I would hope that the Reserve Bank of India never lets down its guard. The guard has to be up 24/7. And we have to be conscious of that, given that we are a much more open economy now, and that any shock in the world can affect us. That I would say that certainly, whether it's Christmas, non-Christmas, New Year's, etc., you have to be careful all the time. And particularly, again, when I would repeat, I would say that once again, particularly when you're opening rupee bond markets more than ever before.
Absolutely. I think no central bank, particularly an emerging market, can ever afford to have its guard down. But Rakesh, will you concur with me when I say that it took a woman, Janet Yellen, to undo the mess created by her predecessors, whether it be Alan Greenspan with the Greenspan Putt or Bernanke, who dithered for the past 2 years and he couldn't take this decision. So does it require a woman to take these bold decisions? Honestly confess?
Oh, absolutely. But also I can, on a lighter note, it must be because I had lunch and dinner with her a couple of years ago, just before she became the Fed chair. So I must have affected her in terms of being more sensitive to our needs.
Oh, well, absolutely, that's true. But as far as we're concerned, we can never let our guard down. That is clearly clear, sir. As Rakesh mentioned, as far as bond markets are concerned, I think we need to be very, very careful about the pace at which we open. Because remember, capital account convertibility and all that sounds very nice. But for a country like ours, which has problems, we need to think of what's happening in the real economy. The external sector, the financial sector, these are all byproducts really of what happens in the real sector. So we have to keep one eye on the Fed, but maybe 2 eyes if possible on the domestic economy. Thank you so much, Anant, as well as Rakesh, for joining me on this discussion. It's been great having you. Thank you also for watching. We'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.